Rio Tinto's first half results landed well clear of expectations. Underlying earnings rose 43% year-on-year to $6.9 billion, marginally ahead of the $6.81 billion consensus. Underlying EBITDA climbed 28% to $14.8 billion, essentially in line with forecasts, while free cash flow surged 75% to $3.8 billion. Management responded by lifting the interim ordinary dividend 43% to $3.4 billion, holding the 50% payout ratio. That marks a sharp reversal from the first half of 2025, when Rio actually cut its interim dividend amid weaker results. Shares closed the session up 3.67%. Yet the strength did not settle the debate. Within a day of the results, Jefferies downgraded Rio Tinto from buy to hold and cut its price target from 5,700 pence to 4,600 pence. If the earnings beat expectations and the dividend jumped, why would a major broker turn more cautious rather than less?
The segment breakdown explains the split reaction. Copper EBITDA came in at $5.7 billion, 84% higher than a year earlier, and 7% ahead of estimates, as the Oyu Tolgoi mine continued its ramp-up. Iron ore EBITDA, still the largest single segment at $6.8 billion, actually missed expectations by 2%, despite record first-half Pilbara production. Copper, aluminum, and lithium combined now contribute more than half of underlying EBITDA. As one analyst put it, these results tell the story Chief Executive Simon Trott wants to tell. Rio is no longer an iron ore company with a copper hobby. That is a genuine structural shift, not a one-quarter blimp, and it is the headline the dividend increase is really funded by. But the same report carries the source of Jefferies' caution. Diesel prices, a direct input to Pilbara unit costs, rose from around $85 to $140 a barrel in the first half, adding roughly 80 cents per ton to costs. Net debt did fall to $14.1 billion, against an expected rise toward $15.4 billion, keeping the $5 billion capital release target intact, but capital expenditure on Simandou, Oyu Tolgoi, and lithium leaves less flexibility than in Rio's net cash era.
The wider analyst picture underscores the disagreement rather than resolving it. Rio Tinto currently holds a strong quantitative score from one data provider, yet the consensus rating across sell-side analysts sits at hold, made up of 2 buys, 5 holds, and 2 sells. That is an unusually even split for a stock that just delivered a 43% dividend increase. The bear case, as reported, is that the earnings and EBITDA beats were small in absolute terms, and much of the share price move reflects sentiment and positioning rather than a wholesale change in fundamentals. The 2% iron ore EBITDA miss and a roughly 1% shortfall in combined aluminum and lithium earnings support that reading, even as copper outperformed. For a holder or a prospective buyer, the evidence points to a genuine but incomplete transition. Copper is now doing the heavy lifting, and the dividend increase is real cash, not accounting. But iron ore, at close to half of group EBITDA, remains exposed to Chinese demand and to input costs like diesel at a current one running well above last year's levels. The Jefferies downgrade is best read not as a rejection of the results, but as a judgment that the stock's price already reflects the copper story, leaving less room for the iron ore side to disappoint without consequence.